There are two ways to watch a war unfold. The first is the way most people do it, tracking the headlines, reacting to price spikes, refreshing the news feed, listening to the loudest voices on financial television explain which asset to buy before Friday. The second way is structural, slower, colder, more useful. And what the structural view reveals right now about the escalating tension between the United States and Iran, and before that, Ukraine, and before that, the entire post-2020 geopolitical reshuffling, is not a story about oil prices or defense contracts. It's a story about second-order consequences and why the people who will benefit most from this period of instability won't be the ones reacting to it. They'll be the ones who understood what it was before the shooting started. When conflict enters the picture, any conflict, there's a predictable sequence. First comes the fear spike, volatility surges, crude jumps, defense contractors get a bid, the news cycle saturates, social media fills with opinions. Financial commentators declare that this changes everything. Then comes the reversal. In the weeks following Russia's 2022 invasion of Ukraine, oil climbed from roughly $91 per barrel to $130 within a month, a 43% move in about 30 days. Then it came back down. By late 2022, oil was trading near $80. By 2024, around $70. If you had positioned on the fear trade in February 2022 and held, you would have made nothing over a multi-year horizon. Less than nothing, adjusted for inflation. This is what happens when markets process geopolitical shock. The initial reaction is emotional. Prices move on uncertainty, not fundamentals. Then, as uncertainty crystallizes into actual facts, which are almost always less catastrophic than the fear priced into the first 72 hours, prices normalize. The people who bought oil at $91 thinking the war would push it permanently higher were reading the headline. The headline is almost never where the money is made. The instinct to go to cash looks safer but carries its own structural cost. Assuming a baseline inflation rate of 3% per year, the long-term U.S. historical average, money sitting in cash loses approximately 45% of its real purchasing power over a decade. Not nominal value, real purchasing power, the actual capacity to buy things in the economy. And 3% is the conservative number. Many people experienced what 7%, 8%, and 9% inflation actually feels like at the grocery store, at the lease renewal. If you held cash through that period instead of equity, you didn't preserve capital. You watched it shrink quietly, without a single dramatic headline to mark the loss. There is no safe harbor. There is only which type of risk you're choosing. Over the past 30 years, the world saw approximately 70 armed conflicts of varying scale and intensity. Wars, regional crises, geopolitical flashpoints, regime changes, proxy conflicts, terror attacks. During that same period, the S&P 500 returned roughly 1,200%. The Nasdaq returned approximately 2,000%. The pattern across essentially every major conflict in that span was the same. Initial drawdown of 5% to 15% in the weeks surrounding the shock, then stabilization, then recovery. In most cases, within 12 months, the market was not just recovered but significantly higher than before the conflict began. The S&P 500 doesn't price in the suffering of people in conflict zones. It prices in corporate earnings, liquidity, and consumer behavior, none of which are permanently destroyed by regional military action. Geopolitical crises, throughout modern financial history, have functioned as temporary volatility events rather than structural turning points for broad equity markets. The distinction that actually matters is between first-order and second-order effects. First-order effects are immediate and legible. Oil spikes, defense stocks pop, airlines sell off. These are the moves financial television covers because they're fast and they make for good content. Second-order effects are slower, less visible, and structurally more durable. What happens to the global demand for advanced defense technology over the next decade when every government in the world watches the current situation and recalibrates its own security posture? What happens to AI-driven intelligence systems when the complexity of modern threat environments makes traditional human analysis insufficient? What happens to the intersection of defense infrastructure and data architecture when warfare increasingly involves information dominance and adversarial pattern recognition rather than just kinetic force? These questions don't get answered in the first 72 hours of a conflict. They get answered over 5 years. Second-order effects play out in years, not days. They're invisible while everyone is watching the first-order moves. That's precisely what makes them valuable. NVIDIA went from approximately $25 to over $180 in the years following Russia's invasion, a period when the company was essentially uninvestable to anyone focused on headline geopolitical risk. Google is up over 130% since that moment. Microsoft and other large-cap tech companies followed similar trajectories. The short-term price action said, "Sell tech, the world is too uncertain." The long-term fundamentals said, "These businesses will be structurally larger and more essential in 5 years, regardless of what's happening in any particular theater of conflict." The fundamentals were right. There is a structural shift occurring in how governments and militaries acquire and deploy capability, one that predates the current Iran situation and will continue long after it resolves. The traditional defense contractor model is being displaced by something more complex. Governments increasingly require not just physical systems, but data infrastructure, the ability to process intelligence at scale, model adversarial behavior, and integrate disparate information sources faster than human analysts can. Companies operating at this intersection, where government defense contracts meet artificial intelligence and data architecture, occupy a structurally unusual position. They benefit from near-term budget increases that conflict drives, because conflicts always increase defense appropriations. And they benefit from the long-term secular shift toward AI-driven operational capability, because that shift is happening regardless of whether any particular conflict is active or resolved. Most assets are correlated with volatility. They go down when uncertainty spikes. Assets at the defense-AI intersection tend to move differently. Uncertainty and conflict increase the perceived value of intelligence infrastructure. Calm periods increase the demand for modernization investment. The thesis is less exposed to the binary outcome of any single geopolitical event. Palantir Technologies is the most documented structural example of this architecture. Roughly half its revenue comes from government and defense contracts. The other half from commercial AI and data analytics work in private markets. Since February 2022, the stock has appreciated over 1,000% during a period when most observers were focused on oil prices and cash positions. The persistent objection to a company like this is valuation. The price-to-earnings ratio is too high. The multiple is stretched. This objection has been made consistently since the company went public. It was made when the stock was at $10, at $20, at $40, at $80. At each of those prices, the concern was technically accurate. At each of those prices, it missed the point. The companies that generated extraordinary long-term returns, Microsoft in the 1990s, Amazon in the 2000s, NVIDIA across the 2010s and 2020s, consistently traded at premium valuations. Not because markets were irrational, but because markets were pricing in growth trajectories that traditional frameworks, designed for mature businesses with predictable earnings, aren't built to capture. The investors who waited for the multiple to compress have, in many cases, waded through a 1,000% move. None of this requires timing the market. The logic of structural positioning doesn't depend on correctly predicting whether the US and Iran engage in direct conflict or whether it de-escalates or whether oil spikes to $130 again. It depends on a simpler and more durable thesis, that companies positioned at the intersection of durable secular trends, AI infrastructure, defense modernization, data intelligence, will be structurally larger in 5 to 10 years regardless of the precise path that geopolitical events take to get there. Dollar cost averaging, committing fixed amounts on a regular schedule through volatile periods and calm ones, is a mechanical system for removing the emotional component from the decision. It doesn't require predicting the bottom. It buys the bottom when it happens, along with all the other entry points. Across 5-year periods that included multiple geopolitical shocks, tech recessions, pandemic shutdowns, and inflation spikes, consistency has produced outcomes that reactive, headline-driven positioning hasn't. The current situation is loud. Markets are pricing in uncertainty. The temptation to act on the specific geopolitical outcome is understandable, but the investors who have systematically outperformed through previous versions of this environment didn't outperform by correctly predicting outcomes. They outperformed by refusing to let first-order noise distract them from the second-order signal. The world has never been on a steady upward trajectory. It is chaotic, occasionally violent, and structurally uncertain. It has always been that. The S&P 500 returned 200% through 30 years of that same chaos. The question isn't whether this particular crisis changes everything. It almost certainly doesn't. The question is whether you're positioned to benefit from the structural consequences of an increasingly unstable world, or whether you're watching the oil price and waiting for the situation to clarify. By the time it clarifies, the second-order move is already half over. That's a structural question. Not a political one, not a moral one. Where do you sit within the system that absorbs the consequences of global instability? And is that position where you intend to be?